Welcome to an Alternate Hue. I'm Hugh Anderson, and this is some of what caught my attention recently. Hightower Las Vegas has erred on the side of caution this year as the financial markets moved higher while economic fundamentals were mixed, at best. We continue to be concerned about the fundamentals and think prudence is appropriate in the current environment. But data continues to challenge our position, and we always recommend looking under the hood to make sure we're not missing something. For example, Dave Rosenberg highlighted the recent GDP report showing the economy expanded at a 5.2% annual rate in the third quarter. This prompted a bullish response from the stock market, but when you look at the monthly pattern of real GDP, 60% of the third quarter bounce was concentrated in July. That was 5 months ago. Another factoid to consider, the Russell 2000, which is a small company index made up mostly of U.S. companies, of that index, 40% of those stocks, those companies, have no profit. Now, instead of kicking the bums out, members of Congress are leaving of their own accord. 2 more members of the House announced they would not seek re-election, bringing the number of retirements to 12 in November alone. This is the most in a single month since Ballotopedia began tracking in 2011. Departing comments from some of the members include, quote, "It's insane and it adds no value to my life. The things I care about, I can do better, just not here," unquote. Quote, "It's stupid. You know, impeach that person, censor that person. It's all political, so members can go raise money and talk tough back home," unquote. Well, regardless of one's political affiliation, being an elected official has become untenable on so many levels. Where once it was tough to get the best and brightest to run, now it's virtually impossible given the current hostile environment. That environment makes life miserable, if not impossible, for policymakers to do the job they were elected to do. Rest assured, lots of talented people are not clamoring to go to Washington, D.C. these days. Now, there's an old adage on Wall Street that says, money goes where it's treated best. Take a look at this. This graphic shows an inordinate amount of millionaires leaving China, India, and some other fast-growing economies and moving to the U.S. and Australia. Interesting, to say the least. Now, hedge fund herding is worse than ever, according to Reuters. Now, just as it sounds, herding is defined as the act of bringing individual animals together into a group, maintaining the group, and moving the group from place to place, or some combination of those. Herding can refer either to the process of animals forming herds in the wild, or to human intervention forming herds for some purpose. The U.S. stock market's Magnificent Seven has been a headache for actively managed mutual fund managers who have mostly stayed away from them given their lofty valuations, and those managers are paying a performance price. Hedge funds, on the other hand, have taken a different tack. They've jumped in with both feet and own a bunch of those stocks. Hedge fund crowding is now the most extreme it's been in 22 years, according to Goldman Sachs. So for the privilege of paying a 2% management fee at least and 20% profits at least, you too can own the same portfolio as just about everybody else. As I mentioned before, third quarter GDP was reported as 5.2%. A very strong number indicating a healthy economy. Interestingly, government spending was revised higher, but consumer spending was lower. The government is in the middle of a $2 trillion, that's right, trillion with a T, annualized deficit spending spree, even though we're not currently in a recession, according to some. This deficit is almost 3 times the amount during the Great Financial Crisis bailout. The media keeps harping on how well the economy is doing, but people don't seem to be too happy about it, and pollsters and the media can't figure out why. Well, maybe this can explain it. On the left, you see private sector workers are seeing a steady decline in earnings. On the right, those that work for the government seem to be doing A-OK. As the old joke goes, the stock market has predicted 9 of the past 5 recessions. The count rose to 10 last year as interest rates jumped and stock prices fell. The all-important U.S. yield curve, and as a reminder, think about what you're earning on money funds in the short term versus what it would cost you to take out a 30-year mortgage, is the yield curve. And this spread turned negative and historically has been a reliable indicator of a looming recession. Yet the U.S. economy continues to expand and stock prices are up this year. But what happens if Uncle Sam closes the public wallet? Might things be different? And what are the odds of that happening in an election year? And while a lot of government spending can be found in hiring for government positions, the private sector may be sensing something is amiss among the rosy forecasts. So that's it for this week. I hope you got a little bit of interesting data out of that couple of minutes. I hope everybody watching has a happy and stress-free holiday season. I'm Hugh Anderson, and this has been